If you're hunting for high income, you know that it often means taking on some serious risk. Well, today we're diving into an ETF that lives right at that intersection. It's the VanEck Mortgage REIT Income ETF, and its ticker is, you guessed it, MORT. So let's pop the hood and see what this thing is all about. Look, we all know it's tough out there. Finding reliable sources of income for your portfolio can feel like a real challenge, especially when the markets get choppy. And that search for yield? It can lead you down some interesting paths into some, well, less traveled corners of the investing world. And that's exactly where we're going today.
All right, so here it is, the MORT ETF. This fund is built with one main goal in mind, generating income. And it does that by investing in a very, very specific kind of company. So, what's the actual game plan here?
At its heart, MORT is what you'd call a passive index fund. That means it isn't trying to be clever and pick winners and losers. Nope, its only job is to mirror the performance of the MVS US Mortgage REITs Index. So you get direct exposure to that whole slice of the market. And of course, that kind of access comes at a price. And that price tag is the fund's expense ratio, which comes in at 0.42% a year. But to really figure out if that fee is worth paying, we need to get our hands dirty and understand what this ETF is actually buying. So what on earth is a mortgage REIT? You'll often hear them called mREITs for short. Now, these are not your typical REITs. A traditional REIT might own shopping malls or apartment buildings. But mREITs, they're basically finance companies. They don't own the physical properties, they own the loans on those properties. Their entire business is about collecting the interest paid on all that mortgage debt.
Okay, so the business model for an mREIT starts out great simple. They buy up mortgages and collect the interest payments. But here's the secret sauce, and it's the source of both the sky-high yield and the sky-high risk. It's called leverage. Think of it this way. They borrow money at cheap, short-term rates to buy mortgages that pay higher, long-term rates. The profit is whatever they can make in that gap, that spread. And when it works, it's like pouring gasoline on a fire. It just supercharges the returns.
And that brings us to the other side of the coin, right? High income almost never comes for free. There's always a trade-off. And in the case of MORT, the fund's own documents are incredibly upfront about what you're getting into. This isn't buried in the fine print, folks. This is a direct warning, a higher degree of volatility, and the possibility of significant losses. So let's be crystal clear. This is not some sleepy, conservative income investment. The risks are real, they are substantial, and they come at you from a few different angles.
First up, we have interest rate risk. And for mREITs, this is a nasty double-edged sword. If interest rates go up, the value of their existing portfolio full of old, lower-rate mortgages goes down. Simple as that. But what if rates fall? Well, then homeowners rush to refinance their mortgages. This is called prepayment risk. The mREITs get all their money back way too early, and now they're stuck having to reinvest it at the new, lower rates, which just crushes their profit margins.
Then you've got two more big ones. Credit risk is the obvious one. If the economy hits a rough patch and people can't pay their mortgages, that income stream just dries up. And then there's leverage risk. Remember that secret sauce, that gasoline on the fire? Well, this is the dark side of it. The same borrowing that can juice up your gains will absolutely magnify your losses when the tide turns against you.
And wow, this chart right here shows you exactly what that high degree of volatility warning looks like in the real world. Just look at these annual returns. You have great years, like in 2016 when it was up over 23%, but then you have these huge drops, down almost 22% in 2020, and then a massive loss of nearly 27% in 2022. I mean, this is the textbook definition of a roller coaster.
And if we zoom in from years to just 3-month quarters, the picture gets even more wild. The fund's best ever quarter delivered a staggering 40% gain. But its worst quarter? A loss of over 57%. Think about that. To lose more than half of your investment in just 3 months, it really drives home the kind of risk we're talking about here. So with all that whiplash, what has the long-term total return actually been? This table really puts it all into perspective, comparing MORT to the good old S&P 500. Over the last decade, while the S&P 500 averaged over 13% a year, MORT averaged just 1.86%. It's a really stark reminder that a high yield doesn't automatically mean a high total return, especially once you factor in those big price drops along the way.
So, at the end of the day, MORT delivers exactly what it says on the box. It gives you concentrated exposure to the high yield but very high risk world of mortgage REITs. It can be a powerful tool for income, but you have to see it for what it is, a roller coaster that doesn't come with seatbelts. So the real question you have to ask yourself isn't just about whether you want the income. It's about whether you have the stomach for the ride it takes to get there.